Every market crash in history felt unexpected. 2008, 2020, even the dot-com bubble. But here's the truth. Crashes don't come out of nowhere. They follow a pattern, a science. And right now, in 2026, we're seeing signals that are very different and potentially more dangerous. So the real question is, are you prepared? Or are you about to be blindsided? Let's break this down like a strategist, not a gambler. 1. Interest rates, the silent killer. When central banks raise interest rates, money becomes expensive. Loans get costlier. Businesses slow down. Consumers stop spending. And suddenly, growth starts to choke. High rates don't crash markets instantly. They squeeze them slowly until something breaks. 2. Inflation, the hidden pressure. When inflation stays high, everything becomes expensive. Food, fuel, housing. People have less money to invest, and companies face rising costs. Margins shrink, earnings fall, and stock prices, they follow earnings. 3. Panic selling, the psychology trigger. This is where science meets human behavior. When markets drop 5%, people get nervous. At 10%, they get scared. At 20%, they panic, and panic creates a chain reaction. Selling more, selling, total collapse. Crashes aren't just financial, they're psychological. Avalanches. But here's the part most people don't understand. Every crash plants the seed of recovery. 1. Government stimulus, the reset button. When things get bad, governments step in. They lower interest rates, inject money into the economy, support businesses and banks. This creates liquidity, and liquidity fuels markets. 2. Institutional buying, smart money moves. While retail investors panic, institutions do the opposite. They buy when prices are low, because they understand one thing: crashes create discounts. 3. Buying the dip, the crowd returns. As soon as markets stabilize, confidence comes back. Retail investors re-enter. Prices start climbing. Momentum builds, and just like that, the recovery begins. Now, a real question. What should you do? Strategy 1. Diamond hands. Hold through volatility. Don't panic. Works if you're invested in strong assets. You have long-term patience. Risk. You could ride the market all the way down before recovery. Strategy 2. Stop loss. Set a predefined exit point. Works if you want to limit losses. You're trading short-term. Risk. You might exit early and miss the rebound. The smartest investors don't choose one. They combine both strategies. Protect downside, but stay positioned for upside. Now let's talk about right now. Why 2026 feels different. 1. Overvalued markets. Stock prices are rising faster than company earnings. That's not growth. That's speculation. 2. High interest rate environment. Rates are still elevated, which historically pressures markets. 3. Excessive retail participation. Too many inexperienced investors chasing quick profits. That's often a late cycle signal. 4. Everything is fine narrative. When everyone believes the market can't fall, that's usually when it does. Market crashes aren't accidents. They're cycles, driven by money, policy, and human emotion. And 2026 might just be the next chapter. So don't just watch the market, understand it. This content is for educational purposes only. It is not professional financial advice. Investing involves risk. Always do your own research.